here, but good morning, good afternoon, wherever you're calling in from. Super excited for today's session on lease accounting. For those who don't know me, I'm Em Daigle. I'm the founder of OTTO-MATES. It's a community for accounting and finance professionals who are navigating AI and automation. Before we jump in, just a couple of quick housekeeping items. We are recording this session and we're going to be posting it out to the rest of the OTTO-MATES community on the Circle platform for future reference, so it will always be available there. We will save some time for Q&A at the end, so if you have any questions along the way, you can drop them in the chat. And then we're aiming for about 45 minutes today to give you a little time back before your next call. But it also means we do have a little wiggle room as well if we get a number of questions. So today we're going to be tackling lease accounting. It probably isn't a new territory for many of you, but the complexity is definitely growing. Companies are now leasing everything from like servers to software capacity, and the gap between how well we handle the lessee versus lessor accounting aspect of it keeps sort of widening. And RightRev has a really cool way in which they have attacked the lessor side of the house. So we're going to kind of walk through what it all means today. Alyssa, if you want to jump to the agenda slide, just to give you all sort of an idea of what we're going through. Sort of looking at lessee versus lessor, just as a refresher on the differences and where some of those risks might be hiding. And then a little bit on the difference between like the ASC 842 and IFRS 16 reporting and where that actually matters and why modifications tend to sort of put that at even more risk and blow everything up. So we'll go through and do all of that, but we'll start with some intros today. I'm thrilled to have both Jagan and Laura with me today. Jagan is the CEO of RightRev. I've had the pleasure of working with Jagan for a number of years now in various capacities. Way back in, I think we first met Jagan in like 2009, 10, somewhere in there. So it's been a number of years now when I was a customer of his. And then Laura from CDK, super excited to have you here. Laura has been tackling this lessee, lessor, everything in the trenches, trying to solve the exact problem that we're talking about today. And so she's in the thick of it right now. But Laura and Jagan, thank you so much for being here with me. Jagan, could you give us a brief overview of your background? And then Laura, if you want to do the same and for your role at CDK.
Thank you, Em. Jagan Reddy, I'm the founder CEO at RightRev here. Before this, I also founded RevPro, which is now owned by another company. And that was like a couple of decades ago. Like we started RevPro, did the RevRack, like Em said. Em was one of our very early customers, successfully implementing 605, and then we moved to 606. So it's kind of I've lived through the RevRec journey from SOP 97 all the way now to ASC 606. And now here we are tackling another standards of ASC 842 and IFRS 16. I'm happy to be on this webinar.
Awesome. So grateful to have you. And with all those numbers you just threw out, it makes me feel very old. Laura, would you like to go ahead and give an intro too?
Sure. So I've spent most of my career in the accounting space. I currently run also CDK's quote to cash process. So everything from contract execution down through to revenue accounting. And that's a really great synergy because everything upstream affects us in revenue accounting. And I started working on 606 and lease accounting around the time it started in the 2015 to 2018 timeframe, and has been primarily my focus since then, the revenue accounting space. But spent some time implementing lease software for lessees. And then when I came to CDK as a lessor, we ran into some of the challenges that we're working with RightRev now to solve.
Awesome. Well, love that we're kind of all in the thick of this and trying to figure it out together. Just in full disclosure, when we were kind of jumping on here and making sure all of our settings on Zoom worked and everything, Jagan and I were talking about how like we're all kind of in this and learning together. So we're going to do the best we can here and making sure that we're being transparent with what we're seeing and hearing and figuring out. But certainly would be interested to see as we go along if there are other things that folks are running into or questions that we may not have even uncovered yet. So like I said before, please feel free to drop them in the chat. And if we can't answer them right here today, would certainly love to dive in deeper with you on those so that we can learn more about it and pass it on. So, all right, let's jump in. Jagan, let's kind of set the foundation. I want to start with probably something that seems obvious, but maybe rarely gets talked about directly. But when we think about lessee accounting, it has so many more technology solutions and technologies that support that type of accounting versus the lessor side. And so, what do you think has happened in the market that sort of like created this imbalance of so much that is able to attack the lessee side versus the lessor side?
Yeah, I think every time we talk about lease accounting, and when a vendor says, "Oh, we support lease accounting," a lot of customers fail to ask a question: Are you supporting the lessee side or the lessor side?
Mm-hmm.
So there's two sides of the coin, and the simple answer is it's the same contract, but then it provides two sides. Like, are you on a lessee side or lessor? Lessee is a much more standardized and high volume because there's a lot of people leasing equipments,
Mm-hmm.
like they buy on leases. But compared to the vendors providing products on leases, right? So that kind of covers the lesser side. The lesser side is the accounting is more variable, and it's super tied to the billing and asset operations. So the shape of the problem is super simple for lessee. That's one reason why you see there are so many products out there, and the volume is super high, so they're all solving for that problem. But on the
Mm-hmm.
lessor side, it's just not one problem. It's many business. So basically, on lessor side, you need to figure out what is your asset type. There's a pricing structure you need to figure out. Like, is it a fixed lease, or is it variable, or is it like stepping up, or a CPI linked? There's so many different variations we can talk about. And on the leases, is it services, or is it like non-lease components, because it can be combined into one contract. And you're estimating a residual value. You have to assume what will be your residual value. So for lessor accounting, it's super complex. It's not straightforward like lessee, and that's where we see a lot of people try to automate on the lessee, not on the lessor, and that's what RightRev is trying to solve today.
Yeah, I think that's great. And I think that looking at it from an asset versus liability framing perspective really does highlight how fundamentally different the accounting workflow can be there. So from your perspective, as you started to have some conversations with your customers about this, for a team that has traditionally only dealt with one side, which presumably would be the lessee side, um, what's the most disorienting shift or the transition that they've had to handle or think about when kind of considering the lessor side if it's newer to them?
I think on the lessor, if you really look into it, it always overlaps with the revenue recognition
Yeah.
complexity.
Yep.
um, the accounting intersects with the revenue like patterns, like what is the interest income, what is the variable consideration, and
Hmm.
then on top of that, your contract modifications, your concessions that you give, collectability, that's another headache. Um, and then the third one is mainly about classifying your leases and also separating the leases from non-lease components in a contracts. These kind of creates a lot of complexity for the users that own both systems together. Um, and the second, I would say, the data for the lessor, uh, for leasing, it's super simple. They just look at the contract and they can do things. But for lessor,
Yep.
it's too many things because the data is spread across your billing systems, your asset subledger, your contracts can be sitting on order management too. And when you have lease and non-lease components, then you're doing SSP and allocation, so your pricing can be sitting somewhere. So there's so many different data points to bring in. So that's where we see like it gets like super complex.
Yeah, and it's funny what you just said really resonates because a lot of times I talk to folks and they say they have lease accounting handled or they have it all under control and they understand it. But then sometimes get surprised around the time of like an audit where it gets brought up that now there's this other component. And I think the data aspect of that, and like you also mentioned, the dependency it has on the revenue recognition patterns and fact patterns around all of that, that isn't necessarily something super clear or able to pull out right from the start from a contract and can change over time, truly does come as such a surprise and maybe bite someone in the on the back end. So I think those are really important parts to bring up. Laura, I would love to bring you in here from your perspective at CDK. Does any of what Jagan just described resonate with you or match your experience? Like, where did you find that gap between like we've got this handled and like the reality of what was going on? Like, how did that sort of manifest on your side? Or maybe you knew there was a problem and you were just like handling it along the way, which is entirely possible as well.
Yeah, well, full disclosure, I came to CDK after they had already made some of the decisions, but still, had to learn why we were dealing with this, and really as we look at everything Joggin said makes sense, and of course I did this at other companies as well before I came to CDK and helped them figure out the lease versus revenue accounting split. But I think a lot of people are surprised that the literature requires you to figure out if you have a lease first. Yeah. And that if you have assets that you are delivering in any way to your customer, physical assets, you probably have to do this assessment. Whether you end up in lease accounting or not, you have a physical asset equipment component to your contract. And so you have to make sure that you look at that and assess whether it's a lease or not. And I think especially like just traditional views have gone out the window as the world has changed. So for software companies, especially, we offer services, not physical hardware anymore, right? Or physical CDs that have our software on them. And so it just changed the game where you have this blend of delivering equipment and delivering software in some cases. And I think it just takes people by surprise because that's all been considered one product before. And we do argue for one product in a lot of cases. So that's a possibility, but you have to do the work. And I think it was M who said, like, when you get to the audit and you get this crazy audit question, you're like, what do you mean I have to figure this out? That's where you don't want to be. So it's really anticipating where you have that complexity and then figuring out what your argument is and where you land before you get to that audit question.
Yeah. And I think, it's probably a good segue into like where things get messy in practice, because I see this sort of theme coming up more and more right now that we're shifting and changing so quickly with AI and different go-to-market methodologies and everything. This embedded lease question starts coming up more and more, and it doesn't mean that just because maybe you did or you took a position earlier that you don't have a lease. The way in which you're going to market and offering your products and providing, let's say, the right to use versus right to own versus all of these things, right? That can change what is basically going to be considered an embedded lease. So Jagan, when you think about it and you talk with folks, embedded leases are in tech contracts, servers, cloud capacity agreements, all of these things. How do you, or how are your customers, or how do you think about even starting to identify those and where they might start to slip through the cracks? I think this slide really shows an example of some that are clear indicators of that, but I think just even talking through these in practice makes a lot of sense about where this embedded lease might actually sort of be lingering where folks may not think about it.
Yeah, I can give a quick example as well. Like in overall in a tech contract, the embedded leases they often hide in plain sight, especially in server hosting, private cloud, co-location bundles, capacity-based arrangements. AI is blowing up. There's a lot of hosting and data centers are coming up. So that's why I kind of picked up this particular example. So it's all kind of embedded in the data centers today.
Mhm.
The key question is, does the customer control the use of an identified asset? So if a contract explicitly or implicitly specifies which server, racks, cages, or a dedicated cluster will be used, and the customer controls what runs on it and gets substantially all the benefits, that can be a lease even if the contract is labeled services or managed hosting. So that's
Mhm.
one reason why I said like embedded leases, they often hide in the plain sight. You just need to do more analysis in figuring out what type, whether it's a lease and what type of leases, right?
Yep.
When teams get tripped up in the details, that's where like one of the other things that really that team can forget is the substitution rights. Like you swap the product, now what happens? That's where the modifications also come in. So from how do we how what signals do we look in the contract to see if there is lease embedded or not, right? Some of the typical signals that we have heard from some of the prospect customers we talked to when we were building the Lessor accounting is you look for either like keywords like dedicated, reserved, named hardware, is a single tenant cluster. They're like we got like 10 or 15 different keywords that we can look for. And whether the customer has the decision right? Like what
Mhm.
what workloads they run, when they run it, how much they run. Um, and then also the contract promises we have seen, like whether it's a minimum committed capacity, which is tied to a specific infrastructure. These are kind of the signals that when we talk to a prospect customer, they said these are the things we look at to determine is the lease embedded or not. So that's super important.
Yeah, absolutely. Laura, I'm curious from your perspective at CDK, you're dealing with this obviously at scale. Um, how does your team approach identifying what an embedded lease might be in your contract? Do you guys have and it might be more a what you were doing versus what you're going to be doing, but is it a systematic process? Is it still largely judgment based? Like, what does that look like for your team today?
I would say it's largely judgment based, and I would also say we don't always agree with our auditors. So it's definitely, even if you move from company to company, you want to really understand what the perspective of the auditors are, because there's some gray space here where there's not a black and white answer in the literature. And so I think everything Joggin said is absolutely right. That control aspect is really the key. And that's where you really have to dig in and understand what parts of the asset do you continue to control versus which you do not. And so we actually maintain control of a lot of our embedded assets in our contracts because of the way that we use them for the customer and the way that we manage, for instance, networking services for our customer versus giving them the control of that. That's what they want us for. They want us to come in, set up their networking and control it for them because they want to sell cars. And so we have spent a lot of time on that control question, and it is largely judgment. And it's been a lot of discussions internally, a lot of discussions with our auditors to really understand what are the key pieces of what we do that drive that control. And a lot of times it looks at the economics between both the customer and the lessor and what you're doing. So really, I mean, it's way more complicated than it needs to be, right? It should be either they have it or you have it. But it's why I continue to have a job, I would say, is all of the judgment required in this space. So I think Jagan has a really good understanding of it, agree with everything he said. And I think that control piece, just like with revenue accounting, where you recognize revenue as you transfer control, the lease accounting really focuses in on that same concept. And that's the key to knowing if you have a lease or a service agreement.
Yeah, spot on. I think there's something to be said for the diligence that's required to really understand the components of a contract. Because like Laura, what you were just kind of talking through, why you still need that judgment is it's not always very clearly indicated. And Jagan, you were kind of getting at that too. There's like a few key indicator words maybe, or triggers that might make you question it. But if those words don't necessarily or aren't included in the contract, doesn't mean that it's not present, right? So there's a diligence to understanding what's included in the contract, what kind of rights are included in the contract, like what are the different components of it, and what is that transfer of control, and what does that actually mean? Jagan, from your perspective and what you've done with RightRev, when you have those blended contracts of revenue and leases and services, everything all together, and I know RightRev gives you the ability to untangle all of that, but I'm curious in like just your approach in helping teams to adopt RightRev to do this. What's the process or recommendation to getting that right accounting treatment out of those contracts? Like what's really important that you're looking for to automate that?
I think the way we have built the lesser accounting is and our ASC 606 engine, customers can use them together because the data is the same. It can feed from our revenue engine to the lease accounting as well. It can flow. You don't need to have separate feed for the data. That's number one. So if you're feeding the data into revenue engine, it will feed into the lessor accounting as well. Now, for the lessor accounting to identify is there lease components available there and what are the signals that can do it, I would say today we are looking at the users to classify the leases, but then we are also coming up with auto classification, so it can look at the signals on the contract to automatically figure out is there leases embedded and recommend to the users. We are not going to make the final call, but then the idea is we will recommend back to the users that we do see there's a lease component enabled, and you can verify and say, okay, do we need to do lessor accounting or not? So that's super important. Once the user makes a decision, then our system is a configurable engine where you can clearly set up how to classify the rules. There are thresholds that comes with the standards, and those thresholds can be tweaked based on every customer, how they want to handle the threshold. We set it with the standard, but then you can move up and down, and the system automatically calculates the threshold and can classify the lease, what type of leases they are. Following that, it separates out the lease component. It's going to automatically project your billing forecast as well. So you don't even need to provide a billing forecast. We can generate our billing forecast. The only time that we need a billing forecast from our customers, or if there is variable billing schedules, right? Like we can do standard, but variable, we have no idea. So the customers need to provide it. Now, once you have the contract information and the billing schedules, then the system can automatically calculate. Of course, the other major thing is your contract asset that you have to estimate, like what is the value. Once you have that, the system can use the fair value that we bring it from the 606 engine to the asset and calculate your net present value. It will calculate what is the actual interest that coming out of every payment that you do. And we also take the different GL accounts we capture to say, what is your interest income? What is your expense income account? And then classify the asset from your typical liability or asset into a lease liability, right?
Yep.
And further, we go one more step to classify them into a long-term and short-term. So now you can see the complexity you can get into to do this. There's so many different things you need to do, and we're kind of bundling all this in one. It looks like super easy, but then it needs to derive all this. It needs to make a lot of decisions upfront.
Mm-hmm.
Once the decisions are made, then the accounting engine will kick in to do all this proper accounting. Now, I can keep talking more and more on this because this is we're talking about contract. Now, when the modification happens, you have to like kind of literally redo everything, and then you're redoing your billing forecast because billing forecast will change. Now, your entire the asset and the liability, the long-term, short-term classification rate. So the whole thing changes every time this contract mod happens.
Yeah, well, and it's so funny because when you think about it, and I think that's why some folks so easily are just quick to say, no, we have lease accounting handled, because just hearing you talk through that at I'm going to say simple and higher level sort of perspective. If you think about having to do that for every single contract that involves that embedded lease, that becomes obviously extremely painstaking if it's manual. I think what you also just unpacked there too, maybe without even meaning to, but it really highlights that there's that subledger disconnect for many of those systems that handle quote unquote leases today, where it's the lessee side of the house versus the lessor, and that really important connection that you need, which kind of brings me to my next question around the reporting aspects of it. Now, we don't need to go down the path too far like too technically, but I know from like a ASC 606 perspective versus IFRS 15, maybe not hugely different reporting differences there. But I think from my understanding and what I'm kind of learning as I go along is that ASC 842 and IFRS 16, sorry, I'm trying to make sure I get these all aligned and correct, have greater maybe differences there that are even more important to make sure you're understanding the gaps, but also lining up systems that don't necessarily treat these as completely different work streams and do tie everything together for you. So can you help me unpack that a little more? Like, what happens when these standards need to talk to one another, but the systems aren't necessarily designed for it, and then creates those reporting gaps?
So before I answer, let me ask you a simple question. When we were doing ASC 606, have you ever heard from any customer they want to compare a transaction between ASC 606 and IFRS 15? Have you heard any time?
Of
You
course,
always you,
every
you
time.
always do 606 to
But
605.
yeah, I was going to say, but they just know that these are the same thing, and like that it doesn't really matter, and they can use the same system for the same things.
But you never compare with US GAAP to
Yeah.
IFRS, right? But it's we kind of started building the product in the same way, and I was like blown off when one of the big four and also like few prospects said, "Can you compare with AC 842 and IFRS 16?" I'm like, "Where is that requirement coming from?" Um, So when you have multiple entities and you're doing like global reporting, there's also like local reporting requirements where they have to classify leases under both guidance. So you run across both engines. So we kind of had to go and change our engine to say, start trying to do things on both standards as well. So to talk about the differences, the key differences, if when we support both ASC 842 and IFRS 15, the number one that comes into everybody's mind is the lease types and how you classify them. AC 842 has three different lease types we classify: operating, sales type, and direct financing. And IFRS 16, there's only two: operating and finance. They don't do sales. And and in the US GAAP, like I said, like they split into three and IFRS is into two. When the changes were happening in this guidance, the US GAAP did a lot of changes to the lease accounting side of it. But on the IFRS, they just carried over from the previous guidance is what they did. There was not much changes. So I want to highlight that. And then number two, which is super important, is on day one, how is the P&L getting impacted? Uh, so under ASC 842, if you have a sales type lease, the selling profit can be recognized at commencement of the contract. Of course, there's other nuances. I'm not going to go there on that, but on the principle,
More complexity.
yeah, like it's like they're subject to collectibility and all of the things, but I don't. Let's not go there. And then on the direct financing, the selling profit is generally deferred on ASC 842. Um, but the IFRS 16, the finance lease model is kind of similar how you do from ASC 842, but with just the presentation, the terminology, and the day one margins, and how you report is a little bit different, but there's not too much on that side.
So it's very complex. There's many differences, especially in a global organization that you need to unpack even more. Like just hearing you talk through these gives me a little bit of anxiety. And, Laura, from your perspective, I know you are part of a global organization. This is probably something that is at the forefront of your mind, and trying to keep all of this straight. Kind of curious from your perspective, like, what was some of the warning signs that you had where you were like, okay, we are going to have to start automating this because handling this manually is just not working, that really sort of like helped you get to that decision and the rest of your team to do that?
Yeah, I think the keys for us, probably the two greatest, is the split of the revenue and the cash flows from the revenue contract, because you sell it all as one. But in certain cases where we do transfer control, we have split those pieces apart. And there's not any system prior to this that really does that split, because it's like 606 or 842. And then, as we've talked about, 842 is primarily lessees. So, figuring out how you're going to allocate that transaction price across is really complex. And then if you are a company that has longer term contracts where you have things like price updates, or you do early extensions, or you have some customers sell their dealerships to other customers, then the whole picture changes. And like you said earlier, you have to recalculate everything. And so when you've got 3 or 4 leases, it's pretty manageable. But when you start to scale to a size where this is part of your normal course of business and part of every customer you have, it can get really large really fast. And although all of the accountants in the room love Excel, it has some limits. And one of them is volume and complex transactions. So when you combine the two, you get Excel crashing, you get people asking for higher powered laptops, and you have a lot of room for manual error. So anytime you can move complex calculations that are at scale into an automation, you're in much better shape, and you have more time to run the business and to do the analysis that you want to do.
Absolutely. So the reason why I have a love-hate relationship with this slide. So the RightRev team was kind enough to send it over, and I got to look at everything before we jumped on, obviously. But I think there's something to anytime you see Excel. The reason I'm talking about this is because you just brought it up, Laura, but for those who don't know, I actually used to have an Excel spreadsheet that was so big, I password protected it and called it Excel, like EX-HELL, because I was like, Excel is like killing me. But that's why I have a love-hate relationship with this slide, because I see it on there and Excel feels like home, but yet it's ugly and it creates complexity. And you can see here in this, I'm going to say mess of like where you're doing all of these different things. Like then I think this is a point in time, right? So then, Jagan, you mentioned modifications a couple of times, which in my experience is where things really start to unravel. And so, yes, this might be a process for a point in time where that contract is the starting point for your accounting. But then anytime there's a change to that, that's triggering a chain reaction, right? So, Jagan, from your perspective, and thinking about the change that's required both across the lease and the revenue recognition, like in practice, what breaks these systems? And like, yes, this visual is a lot anyway, but that's the point of it. But just kind of like talking through like, why is it so hard in practice to keep up with all of this when you've got those modifications and what that looks like?
Yeah, I think see the modifications can happen on several things, right? Like if you're just changing the term of the asset, now your NPVs, your payment schedules, your asset balance, everything changes, right? You're literally recalculating. Now, what about if the product itself is getting swapped? Then that's even more a bigger challenge because your lease classification itself can change. The same, when you swap a product in between of the contract, the lease classification changes, and now we are taking you through a different accounting. Um, so it all depends. It's a step-by-step process. We already know the complications, what we go through in a 606 from a rev rec perspective. Now, those modifications, you take it in and start putting it in the lessor side, like term changes, price changes, product swap, everything has a different impact to it. Now, there's something we don't think of, but it also has a bigger impact is customers are paying, assume it's a monthly, quarterly, whatever, and they miss a payment. They don't pay for it. Now, what happens to your income and everything that you've already scheduled to recognize, that changes.
Mm-hmm.
Now, in 606, I would say like if somebody doesn't pay, the payment really doesn't impact a lot of modifications in 606, but in
Mm-hmm.
lesser, because invoicing matters in 606, not the payments much. But in lesser accounting, the payment really matters.
Mm-hmm.
Invoicing really doesn't matter. When does the payment come? Because your interest, you calculate based on that. So there are these nuances that clearly changes how you do 606 and the lesser side.
You just brought up some things too that I don't think, from a traditional rev rec perspective, as you mentioned, like the payments don't always, I mean, I don't want to say always, but um, it's a very specific statement, but typically those payments won't necessarily change the revenue recognition if a payment is 5 days late, for example. However, it does change on the lessor side. So it's interesting. You've got this very intertwined, dependent rev rec and lease component situation going on. Yet at the same time, you do still need to make sure that you have the expertise in both, because just because there's a change in a contract, it doesn't mean that it's going to affect both sides as well. So you've got to have that balance between making sure that the system is able to share the same data and understand what's going on where it does have dependencies, but know the situations where it doesn't. So you can't necessarily just say, I've got to find this one system that will do uh, two different things. You do want to make sure you have a system that understands both sides, but can still handle those calculations as need be based on what the requirements are for the standard.
Yeah, I think we understood all these complexities, and we didn't want we kind of kept the systems to work independently, but then share the data as well. Like you
Mm-hmm.
said, it change in one doesn't impact make the change on the other. So we kind of work very closely to share the data, but not impact each other. And for some reason, the user decisions on the lessor accounting um, may be delayed because they're working on the RevRec side, but they may come back and do the lesser accounting a little later, and we don't want to hold off the revenue for that. So we kind of
Right.
loosely decouple on this ones.
Yeah, exactly. So, Laura, this might be a great time to dedicate a little bit of this to your experience at CDK, because I think after hearing all this complexity, all the things to think about, it would probably be really valuable for everyone to hear from someone who's deep in the trenches and has a team who is focused on this type of thing. First, can you give us a sense of scale? We don't need exact numbers, but at CDK, what does lease accounting look like in terms of volume and complexity with what you're having to deal with?
Yeah, and I will say we have been working to adjust the way our contracts are written to get out of lease accounting. And because of a lot of these things, and because of the complexity. So we look at really like thousands of potential leases because we deliver printers, as was on the first slide. We deliver networking equipment, and our customers use those in their day-to-day business. So we have to assess each of those products and scenarios to determine control. And so really getting to simplification from a perspective of consistency is probably the biggest benefit when you're dealing with lease accounting, because whether you're in the lease accounting or out of it, you have to continually do this assessment to prove that conclusion. And then when you're in lease accounting, being able to use some of the same assumptions and same criteria for your calculations so that you don't have like each of your products is treated differently is really important. One of the things we have really worked hard to stay out of is the flip-flopping of lease classification. And Jagan mentioned this just very briefly, but if you go from an operating lease to a sales type lease or back, or if you go from a lease to a service contract, and you're doing that within the same period on different contracts, or as you negotiate different terms with your customers, you like just take something that's already complex and you blow it up to almost not manageable, right? And you end up with having to hire a team just to manage that lease portfolio. So making sure that as you do have these instances, keeping some consistent terms so that you can conclude across our entire portfolio, this fact pattern is true, and therefore we are in operating lease or we are in sales type lease. And drawing some conclusions about what you're going to do if you don't have payments received on time and how you're going to manage those really are important aspects. I think that sometimes we are too quick to think the literature is black and white and not bring that judgment in and really talk through in depth. You know, there's a lot of the accounting rules that you can just Like, you can read a contract and 10 people around the table are going to come to the same conclusion. Lease accounting is not that way. And it's because the facts matter and the judgment matters, and really how you're managing those assets with your customers matters to the end. It's not, it's a substance over form.
Yeah.
Accounting rule, right? It's principles based. And so you can't just read and say, okay, well, the form of this contract says it's a service agreement, so I'm done. Or the form says it's a lease, and so I'm done. It could actually be the opposite is true, and you're just calling it the wrong thing in your legalese, and we don't care what the lawyers think, right? We care what's actually happening in substance. And so you want that in substance to be agreed across the table, but also to be determined based on the true fact pattern of your business. And then, of course, we talked a little about the Excel spreadsheets, but I think just early in that journey, understanding, that substance, and then really looking forward to how is your business going to change? What's that 5-year, 10-year plan? And does that change what these physical assets that can fall into lease accounting, what their role is in your business and your customer's business? And understanding that long term is going to be important, because once you set up all those spreadsheets, if you're in Excel, or once you set things up with RightRev, you don't really want to have to go in and revamp it all. And of course, if you have an automated system, that is easier, because we can't all predict those changes. But when you're in spreadsheets, it's impossible, right? It's impossible to say, okay, I've had a major change in my business, I need to account for these differently. Let's just push a button and it recalculates. That's never going to be something that Excel can do. And so you're literally starting from the beginning to build those formulas on your own. So eliminating spreadsheets, simplifying, and understanding your business are some of the keys that have helped us to stay manageable in Excel, right? And then looking to partners to help us automate what we do have remaining as leases is really what our plan is for the future, to get out of that Excel madness.
Yeah, I think you're smart to do it, because I think, and you mentioned it, right? If you're in Excel or in a very rigid system, maybe like it's an ERP that claims some sort of leasing component, but doesn't necessarily have the expertise on the lessor side. I keep pausing because lessee versus lessor on the lessor side. But there's something to, and you kind of mentioned it, like understanding where your business is going, but the way that things are changing in just the market today it's happening so fast that it's hard to even predict where we're going to be in 5 years. So it's interesting to hear you talk through like how you're approaching it, but in a way where, yes, you're trying to simplify, and yes, you're trying to make sure that probably other parts of the business understand the impacts on their decisions and how things are going to be provisioned, or that sort of thing, how it's impacting from a financial perspective, but also setting your team up to be able to kind of handle things that are going to change, because there are things that are going to be out of your control, but you're going to have to be able to manage them, and at the end of the day, handle it all correctly and still feel good that you can go to bed at night, that you've handled it properly.
Exactly.
Which I know is a big thing. From your perspective, and I know you've done this even prior to CDK, but when you, like, what kind of advice would you give to a team kind of thinking about where to start if they're kind of, say they listened in, right? They're feeling a little uncertain about, now, do I have a lease component here? Do I have an embedded lease? Like, where do I even start? What would you advise them? Like, where would you advise them to start as far as like understanding what it means and starting to really understand what their contracts are offering?
Yeah, I think, and this isn't just for lease accounting. I think for anything where you're getting into accounting rules that you haven't been knee deep in, or you thought weren't that necessarily applicable to you, the best way I have found to get a broad perspective and get clear guidance is to talk to some people who've already done this. Whether it's your auditors or like I always have other folks from other firms that I can say, hey, how are your customers dealing with this? What have you seen? What do we need to be thinking about that we didn't even think about? And sometimes you'll get things like, stay away from this phrase in your contract because this is a very high indicator that you're going a certain direction, right? So talking to those trusted advisors, I think is really important. And then the other, and again, this is just good business advice, but accountants can sit in a little box and do their accounting. The way that we are most effective is to understand our business, not just on the surface, but at a deeper level. So I spend a lot of time, and our finance team even spends more time with our product team, understanding what we're selling and why we're selling it, and what does the customer think the value is. And so asking all of those questions, that's how you get down to that substance, is what's really going on out there. So those would be my two biggest pieces of advice, other than what I've already said, which is simplify as much as possible. It is, getting with trusted advisors in your network, or find a network if you don't have one. And then and then really understanding your business on a deep level and what those products are that you're providing to your customers.
I think those are great points. I think there's a lot to be said for the simplification, but when you can't, being able to really break it down and work with peers who have seen it firsthand. And I think being able to leverage that, I think we've got such an insular community of accountants here in the world that we can easily call on peers, whether it's former coworkers or colleagues or a community, whatever it is, to be able to unpack that. So certainly a safe space where you can go and learn more. I know we're just about up on time, and I know we were going to try and keep it to 45 minutes, but I think that this was just such great conversation today. I just want to wrap it up with a few key takeaways or things that we can make sure that we pass along to you. Sometimes it's tough writing notes and everything. We are going to be sharing this out, like I said, on the Automate Circle platform. So if you want to revisit anything or share this with your colleagues, it will certainly be there for you. If Jagan, or if what Jagan shared with you today really either resonated or is causing you to want to dig a little deeper, excuse me, into like how either they approach the unified subledger challenge, or maybe you want to talk through whether or not you have these embedded leases, you can either reach out to Jagan or myself, and we can get you connected with an expert on their end to help talk through this in more detail with you. And also RightRev is going to be sharing a one-pager on lease accounting, which will be a helpful asset. So we'll share that out to you all as well. Check it out, put it somewhere useful so you can refer to it as need be. Shameful plug, if you haven't joined the Automates community already, I would encourage you to join us. Maybe we can talk a little lease shop over there. So you can always join us. Jagan and Laura, I really want to thank you for your time and expertise today. I think we're all learning a lot here, especially around the lessor side of everything. So I really appreciate you joining and sharing your experiences and insights. So thank you so much. I really appreciate it.
Thank you, and thanks, Laura.
All right.
Yeah,
and thank you all. Of course. Can't wait to do it again. Thank you all so much for joining. We'll get those assets out to you. But again, in the meantime, if you have any questions, you can always reach out to us, and we'll find the time to connect. Thanks all.
Thank you.